Hello, tradeologists. Well, today we're going to start actually determining the stocks. This is one thing that is very, very important for you to profit from gamma scalping, is to pick the stock that gives you the highest probability of profit. So in gamma trading, remember that we want the nearest month options, because gamma is highest in the nearest month and gets higher as we get closer to expiration. We also want options that are close to at the money strikes. So we're going to buy a straddle, which is at the money, because gamma is highest at the money. And then it fades and gets smaller and smaller as you go in deeper in the money and farther out of the money. So that's the reason we do at the money straddles, is the gamma is higher, and also we want the front month, in this case, which is the August expiration date, and we want that as well because gamma gets higher and as we get closer to expiration. So the big issue is picking the right stock or index. Now, you can either do an index or you can do a stock, but it's very, very important to pick the correct stock in the beginning. And this is left out of a lot of training programs, exactly how to pick the stock. There's only a couple of people teaching gamma scalping, and it's a little bit of a weak area for most people. Fortunately for you, I've come up with a set of criteria that works pretty well. So what you want to do is basically, I have my own watch list here. Now you can use any watch list that you want. Maybe there's particular stocks that you're following. I have my own watch list over here on the left side of the screen, which shows you a number of different issues that I'm following at any one time. There's no I'm not making any recommendations for any of these. I just happen to be following these because they interest me. But you can also, in the Thinkorswim platform, go to a number of different lists, including personal lists or public lists. The public lists are all of the ETFs, the Dows, the futures, the indices, the NASDAQ 100, the Russell 1000. I like to use the top 10 list. The top 10 list, I don't use the percentage gainers, but I like to see the top net gain on the NASDAQ and the top 10 net gain on the NYSE. Why would I use the top 10 gain on the NASDAQ and top 10 gain on the NYSE? Why wouldn't I use the top 10 losers, the net loss or the net loss on the NASDAQ or the net loss on the NYSE? Well, the reason is pretty simple. One of the things that affects the price of a straddle is volatility. If a stock is going down, the price of the volatility of the at the money straddle is going to be very high. It will increase volatility for that particular stock and for that straddle. And we don't want to pay a lot of money for the straddles that we're buying. We want to try to get a stock that's going to move quite a bit before expiration. We want it to go up and down. That's the goal. We want it to move as much as possible before the expiration date. In this case, it's August, so it's only 20 days away. And in order for us to pay the least amount of money for a stock that's going to move a lot, what we want is a lower cost of the straddle, and therefore we want a lower volatility. So we always look for the top net gainers or the top on the NASDAQ or on the NYSE. This is the current list of the NASDAQ top gainers for today. There's a couple of issues that I see that I recognize. That's BUCY. I also recognize Google, of course. We're going to immediately eliminate Google because of the price of the stock is $487. And if we're buying 10 contracts of a straddle, that could get pretty expensive to trade those back and forth. Juniper is one that looks like it's moving, and it's a fairly reasonably priced stock. I know Juniper Networks. It looks like they just added another one here, top 10 gainers. But there's a couple of issues here, the CRDN, I think, and others. Now, once we have a potential list of stocks, either the top 10 gainers on the NASDAQ, let's take a look at the top 10 gainers on the NYSE. We don't want the active stocks. We want stocks that are actually moving. So let's take a look at the gainers on the NYSE. I recognize ICE, which is an exchange. There's a couple of others that look quite interesting. But let's go back for a second. I think I see a couple of issues that are potential good candidates for gamma scalping on the NASDAQ. So we want to pick a stock that is going up. That's number one, because we want to pay less for the straddle. If the stock has had a recent large downturn in the market, has a large sell-off recently, that will increase the volatility. Increased volatility increases the cost of the straddle, and that's what we want to avoid. So what we're going to do is just take a look at a couple of issues that are on this list and some others that I found recently. Netflix was one that I was looking at because it's in the news today. But let's take a look at BUCY, which is on the list today. It has had a relatively, what we're looking for in the chart is just to see if it's been in a downturn recently. Well, it was, but it was back in the beginning of July, and it's kind of traded sideways since then. So BUCY could be a pretty good candidate because it has been in a sideways movement here for the last couple of weeks. Let's see what else we have here. Juniper, JNPR. Let's take a look at Juniper. Juniper also has been trading down, but within the last month or so, it's actually been trading in a sideways movement. So volatility probably is relatively low, and it's trading up very, very high today. So that's a potential candidate. Let's take a look at another issue here. CRDN. I'm not familiar with CRDN. This also has had a little bit of a downturn. It had a pretty large downturn since October, but since March it's actually been trading higher. So this is also a potential candidate. Now, what do we do when we find a potential candidate? You know, the chart doesn't look too bad. It looks like it's been in an upturn. Volatility is probably fairly low. So what do we do? So the first thing that we should do is enter the symbol into our trade tab to see what the current near month at the money straddle is selling for. If we take a look at Ceradyne, the current price of the stock is at $44.14, and we can also take a look at the volatility of the current options, which is pretty high. It's on the high side. It's around 60%, the implied volatility. So that will give us a higher price straddle. If we take a look at buying the straddle, which is at the money, it's going to cost us $4.88. The one thing that we need to look at, though, before we even do that, is just to make sure that there's enough volume in the stock itself. If we go back throughout the history of the stock over the last several months, we've noticed that the volume is only about 400 or 500 shares a day. Some days are a little bit higher than others, but the average looks like about 500,000 shares a day. That may not be enough shares that I feel comfortable with in trading. You want a really high liquidity. So let's go back to JNPR. Juniper, on the other hand, trades close to 10, 11, 12, sometimes 20 million shares a day. It's quite a bit of liquidity to Juniper. So let's put in Juniper as a potential candidate in our trade tab and take a look at a current straddle. The current price of the stock is $25.90. So the at the money straddle should be the 26. Let's take a look and see how much that sells for. Whoops, I'm not going to buy the vertical. We're going to buy the straddle. Straddle is about $2 for the August expiration. And so how do we determine actually whether that's a good price or a bad price? Well, one thing that we want to do at all times is take a look at the implied volatility. It's at 42%. Is that high or low? It could be high, could be low. We really don't know. If we take a look at the stock itself, we notice that it has been in a down trend. However, it has traded sideways for quite a while, which has helped to reduce the volatility in the issue. The one thing that we want to do for sure, though, is to go over to our trade tab. And this is how we'll be able to determine whether or not this is a good issue to trade. We're going to use 10 contracts in this example at $2 a straddle. Now, as you can see, if we purchase the at-the-money straddle, which is the 26 August expiration straddle, we have a delta starting out at about 29 or 30. Positive deltas. That's fine. That's not very much. That's actually a pretty good number. That's relatively delta neutral. The one thing that we want to do, though, is be a little more scientific in our selection of the stock. So what we want to do is take a look at the probability analysis tab in our thinkorswim platform. And what that does is give us an idea of the stock price volatility, which is 39%, over the next 20 days. In other words, what we want to do is take a look at what the volatility would determine is the probability of the high and the low of the stock price before the August expiration, because we are trading the August expiration. Well, the greater the range that we can capture profits in, obviously the more successful we're going to be in gamma scalping this particular issue. We can also determine from this analysis chart what effect volatility is going to have, whether increasing or decreasing, on our position, on our straddle position. Because remember that we're fighting against theta. I mean, the one thing that we really want to have is a very large range in which the stock price can move in order to profit from the fluctuations. All the time we need to consider the fact that we need to make more than the amount that we're losing based on theta decay. In this particular issue, the theta at the current price is minus $47.69. That means for each day that goes on without the price moving, we will lose $47.69. If we take the date tab here and just simply increase the date, you can see that theta does increase. Oops, I got to increase it. Theta at $40.85 increases each day as time passes and decreases our profitability by the exact same amount. So each day that passes, theta is recalculated, and it as long as the price does not move, we will lose that amount in theta for each day that passes. Let's go back to our current date. The same thing with volatility. Volatility is another problem with gamma scalping, and it's certainly something that we want to take a serious look at. With Vega at 47.57, it means that we can adjust volatility in our analysis tab. If we were to decrease the volatility, you can see that we will, by 1%, we will decrease the amount that we make on this position by exactly $47.50 for each percentage of volatility. If volatility were to increase, we would make that amount in additional profits on our straddle. An additional 1% volatility will increase our profitability by $47.64. So as we do our analysis of different issues that we're considering doing the gamma scalping on, we need to consider carefully the Vega position. That is one of the most important Greeks as far as gamma scalping go, because as volatility increases, we make money. If volatility decreases, we lose money. So it just makes sense that we don't want to buy issues that are at the high range of their historical volatilities. We want to buy them in the low to mid section of their volatilities. And the way we can determine that is simply to go over to our profit charts and determine exactly where the volatility of this particular issue is. If we go over here and put in JNPR, I have already called up historical volatility, but you can go into, let's see, I'll do another study here. And then what I'll do is just to show you how this is set up, I'll go into my studies, go to Apply Studies, and in the left-hand box here, all you have to do is scroll down until you get to historic volatility. Just take that and drag and drop it right into your window, and it will automatically call up the historical volatility. Now, would you say that Juniper Networks is in the lower end of its historical volatility? Would you say that it's in the high end of its historic volatility? Or is it in the middle of its historic volatility? Well, it looks like it's kind of close to the upper end, upper range of its historical volatility. And we already showed in the Analysis tab that if historical volatility decreases, it comes down from these levels. If it goes down by 1% from its current levels, then we actually lose money on the position. Because we are long calls and long puts, we're going to have a positive vega on this position. So let's go back to the profit chart for a second. Now, considering that this is at the higher end of the range over the past 5 years, this is a 5-year daily chart. We want to take a look at the long-term view of the historical volatility. And if the volatility is at the high end of the range, there's a possibility that it could go up a little bit higher. But guess what? We're more likely to come down from this level, because if we take a look at the historical volatility, we can see that it has decreased each time that it's gotten very close to this level. So the probability is that it will decrease rather than increase, and that will hurt our position. Now, there are several factors that besides volatility that help to make this a good candidate for our gamma scalping position, and that is the fact of the price of the actual at the money straddle itself, the range in which it can move, the current stock price, the historical volatility, as we mentioned. And if we put those all together, we can come up with a fairly objective analysis of each of the issues that we're considering. Now, you can, as I mentioned, you can get your list from any place that you like. You can go into your, you can have your own watch list set up. You can go into the TOS tab here for index details, and you can take a look at any of the ETFs, the Dow. You can pretty much select any issue that you want, as long as it's liquid, as long as it's trading at least 1 million shares a day. I would probably say closer to 2.5 million to 5 million shares a day. You're probably better off on the issues that trade a larger number of shares, only because you're going to have a better bid-ask spread on the options themselves, as well as more liquidity in the stock. So you can pick any issue that you want. You can go into a newspaper like the Wall Street Journal, the Investor's Business Daily, and you can select stocks that you see that are in the news. And then once you get a kind of a short list together, you can take a look at it and plug it into a spreadsheet that I prepared for you, which is proprietary to Tradingology and is for your use only. And I'll let you take a look and see exactly what this looks like. But basically all we have to do is take a look at certain variables in the stock that we're considering to doing the gamma scalping with. We're going to be taking a look at several issues, and I'm going to be adding issues down at the bottom here so that you can get an idea of exactly how to enter this information yourself. You will have a copy of the spreadsheet in this folder with the video. We have the variables that we're going to be entering are the stock symbol, the at the money straddle price, the range probability, the stock price, the implied volatility of the stock issue, and the historical volatility. Now, this is not a numerical, the historical volatility is not a numerical entry, but it is a judgment entry, and it's probably the only judgment entry that you're going to have. let's take a look at another issue so we can get an idea of whether or not it's going to be a good candidate for our position. And we're going to talk a little bit more about the gamma scalping analysis that we're going to be using. Okay, let's take a look at a couple of issues and how we plug them into our gamma scalping analysis worksheet. Now, I've already got a few up here, which I have pre-filled in. And what I want to do is I just want to show you, let's take AVP, which is Avon Products. And you can see from a historical perspective that the historical volatility is relatively low on this issue. Now let's take a look at some of the other ones on my trading list. Let's go to Amgen. It's probably, this is a judgment call, but I'd say it's probably in the middle of its range right here. Altera Corporation, it looks like it's probably in the higher end of its range. APC, it's in the higher end of its range. AFL, that's in definitely, Aflac is definitely in the high end of its range. Citigroup, definitely in the high end of the range. Bank of America, definitely in the high end of a very, very, very high end of a long range. The problem with gamma scalping in a bear market like we've had, let's take a look at the Dow Jones Industrial Average. We've been in a bear market, and historical volatilities are pretty high across the board for almost every single issue. So in a bull market, it's relatively easy to find issues that have low historical volatility. You want to buy options when historical volatilities are low, and that gives you an opportunity to pop if the Vega increases dramatically. When we do gamma scalping, it's very difficult to find issues in a bear market. I say difficult, but not impossible. Let's take a look at a couple others here. I went through Netflix. Let's take a look at Netflix. You can see on a historical basis, the Netflix historical volatility is in a relatively low area. So that's one issue that we can actually, looks like we may have some success with. If we take a look at the Qs, for example, let's take a look at the Qs. Again, the historical volatility is at the relatively high level compared to the previous 5 years. So let's talk a little bit about this analysis worksheet, and then we'll go directly into inputting some additional issues so you can see exactly how these are calculated. Basically what we do is we take the at-the-money straddle, the range of probability, the stock price, the implied volatility, historical volatility, and then we get what I call the range index, a cost index, and a profit index. All things being equal, we want the range in which the stock will move as high as possible. And you can see the Netflix range is 10.76, which is a little bit on the high level compared to the other issues that we're looking at. The cost index is simply a calculation of the at-the-money straddle divided by the cost of the stock, the price of the stock, divided by its implied volatility. And we get a relatively low cost index on that because there is quite a low cost compared to the cost of the stock itself. If we go down, there's a couple other issues that are also extremely low cost. For example, American Express and NAIHD, which we've already done an analysis on in this spreadsheet. But I want to take a look at a couple of other issues. We're going to take a look at Disney. We're going to take a look at Clear Channel Communications. And if we want, we can actually do a third here. Let's go ahead and do something like Broadcom, BRCM. Just so you have a feel of how to enter the information into the spreadsheet. Okay, let's go with Disney. First of all, we need to get the at-the-money straddle cost. So let's go over to our Trade tab and enter Disney. The current the last trade of the stock was $31.10. So it's either going to be the $30 strike price or the $32.50, which is going to be at the money. Let's take a look at both of those. The $32.50 is selling for $2.33, and the $30 is selling for $2.35. So we might as well go with the lower cost of the two, which is, even though it's only 2 cents, it's still a little bit cheaper. Let's go ahead and analyze this as a duplicate trade. And remember, we are going to do 10 contracts. And let's spread this out so that we make sure that we have the August expiration in here. Now, once we're here, we can bring up our spreadsheet and begin entering some information. First of all, the straddle cost is $2.33, so we just plug in $2.33 here. The range probability, remember, we want the probability of touching up here, not the probability of expiration. The range here for this issue until the nearest August expiration is $27.46 to $35.05. If we take those two numbers and we subtract from each other, we have $27.46 minus $35.05. It gives us a range of $7.59. So we can go ahead and include this in our worksheet. The current stock price is $31.10. We'll just include that. Using a spreadsheet like this will help us become a little bit more objective and keep us out of trouble when we're doing gamma scalping. The implied volatility for the stock is 37.1%, and we have to calculate that in terms of decimal points, so that is 0.3710. And then what we want to do is take a look at the stock price in terms of historical volatility. So we'll go over to our profit chart here and we'll enter the symbol. And this is where we really need to make a judgment call. If we take a look at the historical basis of the volatility of Disney, you can see that it's currently the last is 23.44. Is that in the lower end of the range, the higher end of the range, or in the middle? I would say it's probably close to the middle of the range. It's not exactly on the high end, and it's not on the low end, that's for sure. So what I'm going to do is I'm going to come back here, and I'm just going to put in mid. And I'll tell you exactly how we use that as we go along. Now, in order to determine the range index, the cost index, and the profit index, all we have to do is highlight these cells and then bring these down and highlight them all. Go to Edit, Fill, Down. And that automatically includes the formulas that we had previously on our issues and brings them right down and fills them in for us. Let's not take a look at these just for a second to do our analysis. Let's do another issue. Let's go to CCU. And we'll take a look at the historical volatility. The historical volatility for Clear Channel Communications looks like it's pretty much on the low end of the range. It's extremely low actually for this issue. So we'll fill that in first since we're already at that chart, and we'll just say low. Now let's go back and get our straddle price. The last trade was $35.88, so more than likely the at the money straddle is going to be the 35. And we're buying 10 contracts. Just for sake of analysis, let's go to the 37.50 and see if it's a different price. This is $1, that's $1.70. So it looks like the $35 straddle is going to be the cheapest. Let's analyze that as a duplicate trade. And if we take a look here, we have a range here, 20 days to expiration, between $34.20 and $37.67. So let's go ahead and subtract those numbers. minus 34.20. That gives us a range of $3.47. We'll bring up our worksheet here. The straddle price was $1. The range probability was 347. The current stock price is 35.88. And the implied volatility is at 14.6%. So that's, if we calculate that in terms of decimal places, it's 0.1466. And then all we have to do is highlight these cells, bring them down, and we can fill down to fill in our values. Okay, let's do one more issue here. That's Broadcom. This time we'll go directly to our trade tab. Enter the symbol. And the stock closed at $23.37. So probably the $25 straddle will be the closest to the money. Let's go ahead and buy that straddle. And we're going to do 10 contracts. Just for the sake of our being as thorough as possible, let's take a look at another strike price. This is the $25 strike price. Let's bring up the $27.50. That's a little bit more expensive, and we can go down to the $22.50. That's $2.35. It looks like actually the $22.50 is the cheapest straddle at $2.35. If we go down to the 20, it's a little bit more expensive. So let's go with the $22.50 at $2.35. Let's go ahead and analyze that as a duplicate trade. And we'll stretch this out so that we get the most recent August expiration so we can determine our range. We're going to use the $22.50 straddle for $2.35. Let's bring up our spreadsheet. Our at the money straddle is $2.35. That's the cheapest we can find. Our range of probability here is between 27.76 minus $19.47. That gives us a range of $8.29. And the current stock price is $23.37. And our volatility is 53.92%, which we need to translate into a decimal. So it's 0.5392. And then let's take a look at the chart and see if the historical volatility is considered low or high at this level, at this particular time. And it looks like, yeah, there's certainly a lot of volatility in this issue, and it seems to be to the mid to the high range. I would consider this to the mid to the high range, and it looks like it's going higher. So it's not in the low end of the range. It's certainly not in the middle end of the range. It's at the high end of the range. I'll just give that a judgment call. And then all we have to do is copy these over. I'm just clicking with my right mouse and then just dragging it over the cells that I want to fill in. And then I go to fill and down. Okay, now let's take a look at this a little bit closer. Now that we've done our analysis, we can kind of determine, actually, this helps us objectify the stock that we should be using for our gamma scalping activities. Let's take a look at each one based on its profit index. Netflix based on the profit index. And remember, we want the range to be as great as possible. In other words, we want this range compared to the stock price to be as large as possible. We want a large range with a stock price that's relatively small because we want that stock to move as much as possible. When the stock moves, we make more money when we day trade using this particular technique. The cost index, basically what we want to do is measure the cost of the at-the-money straddle to the price of the stock divided by its implied volatility. If that volatility is actually high and we've got a relatively low stock price and a low at-the-money straddle, because the money straddle is actually relatively cheap compared to the stock price. So that's relatively low. That's how we basically determine which of these issues we're going to be using for gamma trading. The profit index itself is simply a measurement of the ratio between the range and the cost. We want the range as high as possible. We want the cost as low as possible, and that gives us a profit index. Now, if we take a look at our profit index after all of the issues that we've put into our spreadsheet here, we notice that Netflix has the highest profit index, followed by American Express, followed by BRCM. On the low end of the scale, we have the Qs, which only has a 0.99 profit index. And at the very lowest end is our Clear Channel Communications profit index at 0.51. And it looks like the reason for that extremely low profit index is because of the range. The range here is extremely low. Even though the at-the-money straddle is only $1, the range in which they're predicting, the Thinkorswim platform is predicting its movement, is also extremely low. Let's go back and take a look at that again. I mean, they're predicting a fairly small range in which this stock is going to be moving based on its current volatility. And that's assuming, of course, that the volatility remains the same. It could change, but right now, with the volatility extremely low, it looks like, actually, even though volatility is low, it looks like this stock moves around quite a bit. So this may not be a bad choice. But all things being equal, we want those with the profit index as high as possible with lowest historical volatility. So right now, Netflix looks like it's probably going to be the best choice because the profit index is relatively high. The range index is the highest of all of the issues that we've looked at. The cost index is at the lowest end of the range of all the ones that we looked at. And it's currently at a historical low probability. So that is a very, very good candidate. Our second candidate would probably be AVP, Avon Products. Historical low volatility, relatively high range index, relatively low cost, gives us a nice profit index. We would eliminate some of these other candidates. Usually I use this last column here just to kind of X out the ones that I'm not interested in. I would X out that immediately because of the high volatility. I'll X out that because of the high volatility. That is out, that is out, that is out, that is out, and that is out. Then I would go back again and take a look at this one, which has a relatively small profit range and profit index. So I would eliminate that issue. And just by the process of elimination, go through down through each one of these to determine which one we should probably be doing. Disney is in the middle of its range, so it could come down a little bit, but the range index is fairly low at 0.24. The cost index is a little bit high, so I would eliminate that. So now we've got three potential issues here: Netflix, Avon Products, and Clear Channel Communications. Now, as I noticed on this chart, Clear Channel Communications actually seems to move around quite a bit. But let's take a look at the last 60 days and 60 minutes of this chart. You can see over a 60-day period, this has not moved at all, hardly at all. That's why the profit index has dropped down to 0.51. Over a 60-day period, remember, we only have 20 days to expiration. And the reason that we're using the front month option again is because we want the highest gamma we can possibly get to affect our delta. The more the delta changes, the more opportunities we're going to have to scalp this stock. And if we take a look at this for the past 60 days, you can see that the stock has hardly moved at all. I believe that's because they received some sort of bid out offer, some sort of takeover offer, and that's why the stock has not moved. So we're going to immediately eliminate that option. Let's take a look at AVP again. And we need to look at it over the last 60 days on a 60-minute chart. This has moved relatively good. It's been up and down. It looks like it's moved within a channel, and we may have had a number of opportunities over the last 60 days to actually scalp this stock. So that is a fairly decent option here. That is a fairly good candidate. If we take a look at Netflix, you can also see that it's also had fairly good number of opportunities both up and down over the past 60 days on a 60-minute chart for opportunities for scalping this stock based on the movement of the stock itself. So I would say our number one candidate is Netflix, and actually it also has the highest profit index. So the profit index really does work. Once you plug in your numbers, I would look at the profit index first, then I would go over to the historical volatility to make sure that it's relatively low compared to the stock over the past few years. And if we do look at the chart again, we can see that, let's go back to our 5-year chart on a daily basis. You can see that the volatility is at a relatively low spot. And that means that if volatility does increase, that we will have additional opportunities to profit from this particular issue. Now, if you're going to do more than one stock for gamma scalping, you might want to pick both Avon Products as well as Netflix. And the reason for that is, like I mentioned, that we've been in a bear market now for several months. And it's extremely hard to find issues that have low historical volatility along with a good range in which it's moving around. So in order to increase profits, you may actually want to do both of these issues. There's nothing to say that you can't do both. You can't do more than one gamma scalping issue at a time. The thing that you have to keep in mind is whether or not you have sufficient capital. If you're purchasing 10 contracts on a straddle, that means you're buying 10 calls, 10 puts. The maximum amount of money that you could end up putting, or the maximum number of issues that you could be holding while gamma scalping these issues, is 1,000 shares of the stock that you're going to be doing. So if you take Netflix, for example, at $27.51, you could end up holding approximately $27,000 worth of the stock, not including margin. So on margin, it'd be about $13,000 or so. With Avon Products, you're talking $36.37 a share times 1,000 shares. That's $36,000. If you were to do both of these, that's about $18,000 in margin. That's $13,000 in margin. You would need close to $31,000 if you had to at any one time hold 1,000 shares of each of these stocks. But both of those look like very good candidates, and we'll do further analysis just prior to entering into any type of gamma scalping position, which will be the subject of the very next video. So this is how we use the gamma scalping analysis tool. I've also included a sheet, which we will talk about next time, which will help us determine exactly what our profit and loss is as we go into this trading session. You can see that this gamma scalping analysis tool, though, really does help you quantify and judge exactly which issues you should be gamma scalping and which you shouldn't be. So it's more than helpful if you do have this sheet. It's proprietary, remember, please, and please do not share it with anyone. All right, guys, that's it for today. Trade with confidence.